Welcome to our introduction session on residual cash earnings and an ownership culture. My name is Alex Curatolo, and I am a senior associate at Fortuna Advisors, a management consulting firm that aims to help companies transform their value creation potential through bold improvements to managerial insights, decisions, and behaviors. The objectives of today's session are to discuss what residual cash earnings is and why you should embrace it. I want to start by laying out the 4 major takeaways from today's session, which we will then discuss in more detail as we go through the presentation. 1. Residual cash earnings, or RCE for short, is a singular, comprehensive performance measure that balances short-term performance and long-term value creation. 2. RCE accounts for both income statement and balance sheet impacts to provide a complete business management framework. 3. RCE provides a common language for making decisions throughout the organization. And 4. RCE drives an ownership culture where employees act like they're spending and investing their own money. First, let's start our session together with a story. One day, your neighbor explains to you that she has an exciting opportunity to open up a small store selling donuts. You know that your neighbor is a wonderful baker, and once you hear her plan, you think that her donut business could really be a success. You've got some money saved that has been earning you 10% per year, and you think there's a chance you could make more money by investing in your neighbor's donut store. So you take $10,000 from your savings and tell your neighbor that you'd like to invest it in her business, but that you expect to generate at least a 10% return on the money you're investing. We call this your required return. Multiplying your investment amount of $10,000 by your required return gives us the minimum your neighbor would need to generate to meet your best available alternative of investing your money somewhere else. We call this your capital charge. So your neighbor takes your investment, purchases the space and equipment she needs, and then opens and runs the bakery, making some delicious donuts. At the end of the year, your neighbor comes to you and passes along your cash profits of $3,000. Are you happy that you invested? Would you invest again? Let's look at the results. So you earned a cash profit of $3,000 on your investment of $10,000. Given your required return of 10%, that means you needed to earn a minimum of $1,000 for your investment to exceed your best alternative. So you're absolutely happy with this choice because you earned cash profits of $3,000, creating $2,000 in value. What if instead your neighbor came to you and only passed along cash profits of $500? Would you be happy that you invested then? No, since you could have done better by leaving your money to grow in your other investment alternatives. What about if she came to you and passed along $1,000? Then would you be happy? Well, you aren't unhappy, but you're likely neutral because you haven't done better than your best alternative of leaving your money in other investments. To reiterate, this is how an owner thinks. If an owner provides their own capital to run a business, they expect a return on that capital. The same goes for any other company, large or small, and its capital providers. If you understand this story, then you already understand the principles behind residual cash earnings. So now let's start with the big picture what. What is residual cash earnings, or RCE? Residual cash earnings is a comprehensive measure of performance that best captures the true value of a company's assets and its earnings. RCE is calculated by taking gross cash earnings, or the profits generated by the business, minus a capital charge, which represents the amount an investor would expect to earn in exchange for their investment. We'll go into the calculation in a little more detail later, but for now, I want you to focus on how RCE accounts for both the income statement and balance sheet items by including both profits and the investments required to generate those profits in the calculation. Residual cash earnings is likely a new measure to most of you, but once you learn it, the Fortuna team believes you'll find it simpler and more intuitive than the measures you're currently using. As I'm sure many of you have experienced, what often happens is that companies layer measures on top of measures to avoid missing something, which can lead to unclear signals for employees. For example, if your performance is measured both on sales and profits, Should you maximize sales, even if that lowers your profits? Or should you maximize profits, even if that lowers your sales? If metrics don't provide clear signals, how can we expect them to effectively drive employee behavior in our company? At its core, RCE is simple, complete, and applicable to all the decisions made by employees each and every day. RCE motivates three main behaviors. The first is to invest in all growth initiatives that earn more than the required return on new investments. The second is to improve profitability on existing activities. And the third is to get rid of or divest capital where the activities are worth more to someone else. Now that we've talked about the key behaviors RCE motivates, let's look at a few RCE specifics. First, remember that as we talked about, gross cash earnings, which represents the profits of the business, or after-tax EBITDA, earnings before interest, taxes, depreciation, and amortization, less a capital charge, which is the gross operating assets of the business multiplied by a required return, equals RCE. Now let's take a peek at what that calculation looks like in a company context. Using a simple two-year calculation, first, we take revenue less cash expenses to calculate our profit component, gross cash earnings, or GCE. Then we multiply the gross operating assets of the business by our required return to determine our capital charge. Next, we subtract our capital charge from our gross cash earnings to determine our RCE. And finally, remember how RCE focuses on improvement over past performance? We figure out the change in our RCE compared to the previous year to determine whether we have created or destroyed value year over year. In this example, RCE has increased by $20 from 2020 to 2021. And because with residual cash earnings, up is always good, we know this company has created value. Next, let's talk about the why. Why should we use residual cash earnings? Not just because it's a great measure, but because RCE motivates behavior. RCE supports an ownership culture, which is a culture where everyone in a company is motivated to think and act like long-term committed owners. So what is an ownership culture, and why should you as an employee want one in your company? Well, first, an ownership culture creates an environment where all stakeholders embrace a long-term owner perspective to unlock the organization's full value creation potential. So let's break that down. What does it mean to act like a long-term committed owner? We've identified 5 key traits that are emblematic of an ownership culture. Spend like the money is your own, practice extreme prioritization, embrace a willingness to fail, more doing and less talking, and it's about the long and the short term. And why is that good for you as an employee? Because like an owner, you should be rewarded for all of the value you create for the company. And an RCE motivated ownership culture rewards you for all of the great things you do day in and day out, unlike other incomplete measures. Now, let's dive into each trait in a bit more detail. Starting with spend like the money is your own. Here are 3 ways you can shift towards this mindset in your day-to-day role. 1, each time you make a spending decision, ask yourself, would I do this if it were my money? 2, cut spending that is wasteful or that does not generate value. If one flavor of coffee in the break room is always left over, remove it from the monthly order. And 3, do spend on good investment opportunities, whether they were anticipated in the budget or not. Sometimes opportunities arise during the year, and like an owner, you should take advantage of them. Moving on to practice extreme prioritization. First, devote more time and resources to your high-performing projects and initiatives. Second, create and follow a method of prioritization for projects and initiatives, no matter the scale. This can even be true just for your own to-do list. Do the most impactful tasks first. And finally, be willing to pivot and reassess priorities whenever critical factors change. Prioritization should not be static. Turning next to embrace a willingness to fail. 1, foster a culture that takes prudent risks while being willing to fail fast. We often find that unsuccessful initiatives can languish. If something isn't working, learn from it and move on. 2, stop measuring against budgets and instead celebrate cumulative improvement. This can drive innovative thinking. And finally, this does not at all mean that you should take risks that compromise on safety or break industry regulations. Next, let's talk about more doing and less talking. First, streamline decision-making processes to avoid unnecessary red tape or analysis paralysis. Avoid the trap of setting up meeting after meeting under the guise of gathering information. Second, shorten or even cancel meetings that are unnecessary to driving forward value-creating initiatives. And third, carve out time in your schedule to complete specific tasks. Make sure you leave yourself sufficient time for doing. Lastly, let's talk about the final trait. It's about the long and the short term. First, measure performance as improvement against the prior year rather than against budgets. Second, establish multi-period stretch goals to really encourage innovative thinking. And lastly, never cut good investments just to meet short-term expectations. Remember, it is about the balance between short and long term. Ultimately, using RCE as a performance measure motivates an ownership culture, and in turn, an ownership culture drives improvements in RCE. So now that we've looked at both a company-level RCE calculation and the ownership culture traits, let's look at two examples to show how RCE can be used for making day-to-day decisions like an owner. First, let's look at a decision related to purchasing machinery. In this scenario, your business needs to make use of a machine this year, but the model you currently have is older and inefficient. You have two choices: replace the machine or refurbish the older model. Either choice would increase your efficiencies, resulting in cost savings. The two big differences are that the replacement machine would cost more upfront, but then less to operate. You decide to look at an RCE calculation to see what insight it can provide. First, you recognize that this decision doesn't have any impact on sales, because you'll be selling the same product at the same price either way, but it does impact cost. Either solution would provide $200 in cost savings. You know that the refurbished machine would cost $150 to operate during the year, and expect that it would be less expensive to run the replacement machine, about $100. So you calculate your profits under the two scenarios and see that you would generate more profits under the replacement scenario. You then turn to calculating the capital charge. You know that the cost of refurbishing the older machine would be $150, implying a capital charge of $15. In contrast, it would cost $500 to purchase the new machine, implying a capital charge of $50. By subtracting the capital charge from the gross cash earnings, we can calculate the RCE generated by each scenario and determine that it would be $15 greater in the replacement scenario. The clear signal from the RCE calculation makes it easy to choose which machinery option to pursue. We'll replace the older machine. Next, let's look at making a customer pricing decision. So you have a customer that makes frequent purchases. Last year, the customer agreed to 30-day payment terms, but this year they want longer to pay. Given these longer payment terms, what price do you need to charge to break even on an RCE basis? On the left-hand side, we can see the calculation of last year's RCE of $110. If we extend longer payment terms, we know that our gross operating assets are going to increase because our accounts receivable, or the money owed by customers, will be higher. For this example, let's assume that the longer payment terms would increase our gross operating assets by $100 for new total gross operating assets of $500. We can then calculate the revised capital charge by multiplying our new gross operating assets by our required return of 10%, or a revised capital charge of $50. Since the question we are asking ourselves is the price required to break even on an RCE basis, we can set our revised RCE equal to our before RCE of $110. Now, we need to think backwards through our calculation. We know that gross cash earnings minus the capital charge equals RCE. So by rearranging those terms, we know that residual cash earnings of $110 plus our capital charge of $50 equals gross cash earnings of $160. Since this is $10 greater than our before gross cash earnings, we know that sales will need to be $1,260 and $10 to generate the same amount of RCE. This means that we will need to raise prices by 0.8% to account for the longer payment terms our customer wants. Now that we have looked at 2 example decisions, let's talk about some ways that you, in your day-to-day role, can improve RCE by acting like an owner. We'll start by talking about how you can impact gross cash earnings, the profit component. To increase gross cash earnings through revenue, for example, you could increase price through effective sales tactics and differentiation of products, or you could grow volume or market share through better product mix and price optimization. You could also improve gross cash earnings through expenses, for example, by driving improvements in efficiency and productivity through better processes, or by following safety protocols to reduce risk and ensure employee and capital productivity. You can also improve RCE by impacting the capital charge, or the opportunity cost of investments in the business. For example, to reduce the capital charge through net working capital, you might focus on achieving improved payment terms or being mindful of inventory levels. To impact the capital charge through capital expenditures, for example, you might focus on spending money smartly by investing in RCE growth opportunities, or by getting rid of capital that destroys RCE, effectively utilizing assets and performing efficient repair and maintenance. Finally, you can reduce the capital charge by focusing on other investments your company makes and prioritizing those investments that will drive value in the future, and by being willing to fail fast, ending projects that aren't driving value. Can you think of some actions that you can take in your role to improve RCE? Remember, all improvement matters. Let's recap today's RCE intro session with our 4 key takeaways. 1. RCE is a singular, comprehensive metric that balances short-term performance and long-term value creation. 2. RCE accounts for both income statement and balance sheet impacts to provide a complete framework, taking into account both the profitability and the investments required to generate those profits. 3. RCE provides a common language for making decisions throughout the organization. And 4. Residual cash earnings drives an ownership culture where employees act like they're spending and investing their own money. Thank you for taking the time out of your day for this RCE introduction session, and the team at Fortuna looks forward to continuing to work together.